Hello, Zoomers. Chris has to mute his computer in here. All right. So, thank you for joining everyone in person here and you guys on Zoom. So basically, we just wanted to, um, did this not save to this computer? Oh my God. It saved it to my home computer. So I put together a PowerPoint that I spent a lot of time on, and I realized that it only saved at my home computer. But I should have a copy that I can go over with. I'm so disappointed in that. On here. All right. We'll work with this one, and I apologize. I spent a lot of time putting this together, but we'll make it work. So basically what we wanted to do today was just kind of go over the current mortgage market and kind of what to expect coming up for the new year, and just some strategies and conversations that you can have with your buyers and sellers on kind of navigating that conversation. So let me start the slideshow here. So um, basically, um, just the agenda here. So a snapshot of the market, what drives mortgage rates, to try to give a little bit better understanding of how mortgage rates work and the factors that affect interest rates, where they may be heading for next year. The biggest thing with projections for interest rates is that a lot of very smart people, they make their best estimates of what's going to happen, but as we've seen over the last few years, a lot of the times their best guess doesn't end up happening. But there is a lot of optimism around mortgage rates and where they're heading. So we'll kind of go over all of that. Supply, demand, affordability, talking points for sellers, and some checklists here. So as a quick snapshot of the mortgage market right now, so the average interest rates for like Fannie Freddie typically is going to be in the low sixes right now. So 6.3 is average for today. US Treasury. So the US Treasury is actually one of the most important factors that comes into play when it comes to where mortgage rates are. So that is the most important thing. So a lot of people have been talking a lot about the Fed fund rate, which you can see below there. So the Fed just recently, what was it, 2 weeks ago, they lowered the interest rates. Mortgage rates are not as tied directly to the Fed fund rate as they are other factors like the Treasury rate. So one of the things that we've seen was, the Fed lowered the interest rate, and so a lot of buyers were expecting mortgage rates to come down when they lowered the interest rate. And in fact, mortgage rates actually went up after they did their Fed rate lower. So it can't be like the Fed fund rate can't really be used as a indicator of what mortgage rates are going to do. Inflation is also another very important factor when it comes to what happens with mortgage rates. So essentially, when inflation comes down, typically mortgage rates are also going to come down. So they're going to also track inflation to a degree, and then home sales, supply, demand, things like that. So like I kind of just explained, so what drives mortgage rates? The benchmark, the most important thing is the 10-year Treasury. So there's typically about a 2% difference, but just to give you a little bit of an idea of what the Treasury is that a Treasury is a bond that people can buy as an investment. It is one of the most secure investments you can make. And so it doesn't usually have a very high yield, but it's a very secure, safe investment that you can make. So essentially, the way mortgage rates follow that is that mortgage rates, essentially what they are, is mortgages, the way that they work is mortgages get packaged once they close, they get packaged and they get put together as what is called a mortgage bond or mortgage-backed security. And global investors are able to buy those mortgage bonds as an investment. And so typically it's going to be still a more secure investment, but it is going to be a little bit riskier than a treasury. So essentially what the mortgage-backed securities are going to follow that treasury, but it's going to come with a little bit better of an investment for the mortgage-backed securities. That's a very nerdy way to kind of give an idea of how those trend together. But again, inflation, Fed policies, and that's one of the biggest things that we see a lot of right now is there's a lot of different things happening in the economy where there's a lot of big decisions being made, whether it's tariffs, things of that nature. So there's a lot of factors that come into play that no one can truly know what's going to happen, but we'll talk about it here. The expectation is for interest rates to get better. So interest rates, as many of us know, were very low for a brief period of time. So a lot of homeowners currently that own a home, the majority of, I think it's like 70% of people have an interest rate below 4%. So for that reason, there's a lot of people that are still going to not sell their home. They're going to stick with that interest rate. So that is a factor that's going to help keep inventory still lower. Obviously, in our area, our market, the tides are shifting a little bit when it comes to the buyer-seller market. But with those people still having low interest rates, it is still going to affect the inventory levels. Some more nerdy stuff on here, but there's some details on housing supply and demand. So recent trend, mildly lower rates. So yeah, so over the last, we'll call it last year, interest rates kind of ticked down to the low 6%. They actually got a little bit lower than where they're at today. And again, there was a lot of expectations for the rates to keep coming lower. I mean, there was a huge push for, refinances were coming once the rates get into the fives and everyone was planning for it. And then again, the market didn't necessarily do what they were projecting, and the rates actually ended up coming back into the higher sixes, and now they've trended back down to the low sixes, is where they're at currently. Very nerdy stuff here. I removed a lot of this deeper detailed stuff to try to make this a little easier to follow, but unfortunately I saved my PowerPoint that had the better stuff I put on here. But anyways, long story short, this is what they're projecting to happen through the rest of this year into next year, is that interest rates are expected to continue to get better, potentially down into the fives, probably the high fives through next year. And so a few of the reasons that they are expecting that is inflation is expected to get better, and the Fed cuts to kind of allow the market to get us there, essentially. What could push rates higher? Okay, so here's your caveat to if they are wrong and the rates don't do what they're expecting. Again, a lot of these economic factors that nobody knows what is going to truly happen, that could happen to actually not get us to where the rates keep coming down. So messaging for buyers, and this is the biggest thing. At the end of the day, mortgage rates, obviously they're important, and if the rates do come down into the fives, it's going to open up a significant portion of more buyers, because for every 1% that the rates decrease, it opens up millions of potential buyers when it comes to affordability. But at the end of the day, the most important thing is the monthly payment. And so essentially, when we have buyers who are looking to purchase a home, can they afford the monthly payment? And so there's different things that we can do to help them make homes more affordable. And so things like buying the interest rate down, getting things like seller's concessions can help a lot. Things like locking and floating. So for those that don't know the difference between a lock and a float. So there's really three different options when it comes to locking in your interest rate. So the first one is locking it in at a pre-approval. That one is going to be and it's going to vary from lender to lender, But for a client to be able to lock in an interest rate at pre-approval, they're typically going to have a full underwriting approval. So not your typical, hey, they applied, they provided their initial documents, we looked at their pay stubs, it looks like they're going to qualify, so we'll issue a pre-approval. To lock in an interest rate typically with a lender, it's actually going to have to go through a full underwriting analysis and get a full loan approval pending finding a home. So that would allow them to be able to lock in the interest rate at that point. That is typically going to happen in a rate environment where there is almost a very for sure guaranteed situation where rates are expected to go up, because you're not going to want to lock in your interest rate if interest rates are expected to come down. So right now we're really not in that environment. So at pre-approval is your first opportunity. The second opportunity that comes into play when it comes to locking in a client's interest rate is once the contract is signed and provided. So once we, the lender, get the contract, at that time there's two options. The client can either lock in their interest rate now, or they can float it and see what happens until they get to their closing. So typically that's going to have to get locked in, call it 7 days or so prior to the closing actual date. So there's really a risk reward when it comes to that. So I'm a little more risk adverse, and I have a pretty bad luck for my clients that decide to float. But ultimately the difference is that if they lock it in at the time that the contract is provided, their interest rate is secured. They do not have to worry about interest rates getting worse. They don't have to worry about their rate getting worse, or their points or their charge to get the interest rate getting worse. The other caveat to that is they have an option to float the rate, which means that you are not locking it in and you are going to wait and see closer to closing, which typically is going to be 30 days, what happens to the rates. That is typically going to happen when there is an expectation for the rates to get better. So if the rates are going to continue to get better, then holding off and not locking in the interest rate at the time might be a good option. There is a lot of risk when it comes to that. I just had a client who was buying a fairly expensive house, and he knew the Fed meeting was happening, and he was adamant about not locking in his interest rate. And so we floated it, and rates essentially after that Fed meeting did nothing but get worse. And so fortunately we were able to still help him make it work, but in that circumstance, the floating didn't work out. But again, there's no way to truly know what is going to happen with that. We at Keller Home Loans, we do have a policy where we can lock the rate, but we can also potentially float the rate down if rates get considerably better from the time that we locked it to the time that it closes. So let's say we get the contract, we lock it, and over that 30 days, the mortgage rates just come down dramatically. We can actually reprice it before closing and be able to save the borrow money, so they get a win-win where they were secured up front, but they also get to take advantage of the rates coming down. So there's that. So outside of that, messaging for buyers, plan to refinance when the rates dip. That is always a message to purvey to a client, but I've never been the person that had said, what is it? Date the rate, marry the house. I was never a big fan of that, because you never truly know what is going to happen with mortgage rates. And so if we set someone up with the expectation of, hey, I know your payment's really high right now, but more than likely we'll be able to refinance it and it comes down. But at the end of the day, what if the rates don't come down, just like they didn't over the last few years for a lot of those people that were buying in like the 7s, potentially 8%, and now they're stuck in a payment where it was probably too much that they should have been paying, and they just were told that, hey, the rates are going to come down and I'll be able to save money. And that never happened. So now they're stuck in a house and their payment's higher than it wants to be. So ultimately, my goal is always, when it comes to a client, just to make sure we set the expectation like, hey, this is what the payment is. Are you comfortable with that? If you did have to make this payment for the full 30 years or full 15 years or whatever your term is, and if the rates do happen to come down, great, we will refinance you, we will save you money. But ultimately what it is now is going to potentially be your payment. So I'm just not a huge fan of the overly emphasizing the date the rate thing. So messaging to sellers. So rates coming down, which they have been coming down, does bring in more buyers. So that is good for sellers. So like we're seeing right now, the market has shifted. So pricing right is super, super important. Offering targeted concessions for sellers, like for their closing costs and things like that, can widen the buyer pool. That is a very good strategic way to make your listing stand out, because, and I had a scenario set up here I was going to show you guys. A buyer getting seller's concessions is going to allow them to be able to get their interest rate potentially significantly lower than what they could without the seller's concessions. So there's what's called a points and fees test on the lending side of things. It's a government regulation where the buyer is only allowed to pay so much towards like costs when it comes to the loan. And so it's going to eventually cut them off. So where they could have maybe bought their interest rate down to, like, we'll say 5.75, they could actually use seller's concessions to buy that rate down significantly more than what they could without the seller's concessions. So that rate could end up being as low as like 5%, which, if we're talking like a $250,000, $300,000 loan, that seller concessions could literally save that borrower up to $200 to $250 a month off of their mortgage payment. And so that is significant and can really help increase the number of potential buyers that could afford their house. Turnkey beats, interesting. Tools you can use with your clients. So side-by-side payment sheets. So showing them what payments would look like with the hire. So I do that with all of my clients. I actually have a spreadsheet. Is this not showing my, oh my God, I haven't been sharing this thing the whole time. Chris, you could have told me that.
Well, I didn't think.
Because I'm not the host.
Oh, I'm not either. But I didn't think that you were doing it.
I thought there was this, I have literally it's okay. This is going rough.
What you didn't want.
This is rough. But anyways, I have a spreadsheet I would show you guys where I kind of walk clients through what their payment difference would be with different interest rates. So that helps. Buy downs are also a thing. So the seller concessions can allow the buyer to temporarily buy down the interest rate, which that is going to be like a 2-1. So that's essentially where, if the interest rate was going to be 6%, the interest rate for the first year would actually only be 4%. Second year would be 5. And then from that point on, they would have their regular interest rate. So realtor plays for 24. Near miss. I'm just looking at my slideshow that I have for you guys that you can't see here. So yeah, at the end of the day, really the mortgage market is showing a lot of signs of optimism. And so if the interest rates do end up coming down into the 5s, it is going to be very beneficial for affordability for clients. And then it's also going to help sellers because it's going to open up a lot more of a buyer pool. And ultimately, when it comes to interest rates for you guys on the realtor side of things, that is typically going to be one of the first questions that the clients are going to ask when they get, when you try to refer them to a lender, is what is their interest rate? Or when they reach out to us, that's often the first question they ask is, what is your interest rate? And so the biggest thing is that there is not one interest rate. There is a lot of factors that determine what the interest rate is going to actually be. But if the client is solely interest rate focused, it is going to be much more difficult to sometimes help them make the purchase make sense. Whereas if we focus on monthly payment and making sure that the property and the purchase is affordable to them, that is where things get a lot easier, because then it's a matter of, okay, Mr. and Mrs. Smith, I know you guys, are trying to be around $1,500 a month in your monthly payment. Here's what we can do to help you get that payment and make this house work for you. And if that payment fits their budget, then that's, at the end of the day, that is the most important thing. So trying to not necessarily defer from the interest rate conversation, because they do need to know what their interest rate is, but to focus on affordability and making sure that we can make the house fit their budget. At the end of the day, that's truly what is going to matter, and that is what is going to allow them to move forward with the house purchase. So that's really what I got. I apologize, guys. I literally thought my spreadsheet was showing you, and I also had a different one put together. So I'm a hot mess today. But Chris, do you have anything you want to add to that?
I guess I would say, like, if you're primarily working with buyers, then like, yes, until like we figure out what all is gonna happen with the market, you want to try to be reasonable, but concessions are your buyer's best friends right now, especially even if they do have a ton of money, it is helpful to them, instead of lowballing on an offer, to get the concessions because it can help on an interest rate. And so, I mean, unless they're putting 40% down, it, concessions are still their best friend. But I would also say that on the other side of things is to just be mindful of, if you have a listing, to just do your due diligence on where you're putting your price at. It's not that we're not seeing appraisals come in where they need to come in because of the market, but we are seeing that sometimes they have questions, or the value, like they're struggling on finding comps. And so if you have a listing, try to make sure that like you provide your list of comps ahead of time. Because sometimes that does make a difference. I mean, recently I had one and it was $70,000 under what it was listed for. And then we challenged it, and we got $68,000 back. But if the appraiser had had those comps from the beginning, then we probably wouldn't have had that window. So like the market is shifting, but it's not doing anything crazy as long as they have the details and information that we need to support a value. And then from a buyer perspective, waiting for these rates to do something that we have no idea if they're going to do or not just doesn't make sense. And so from that side of it, that's why I say concessions are your buyer's best friend. And I feel like that's it. Um, Unless like anyone has questions. Hope you didn't mute yourself, because
I don't think I did. Does anybody have any questions? Any like client concerns that have come up with interest rates or things of that nature?
Lori, Bree.
I'm good. Honestly, I thought you were just chatting away. I was a little bit confused. I was like, he's just on a roll, but I was like, what is he talking about?
Yeah, I'm a hot mess. I mean, I thought I shared it, but I wasn't the host, so it didn't share and I didn't see it.
And
So
I'm not the host either, so yeah, yeah, it's fine.
yeah.
Well, I also
Worst things have happened.
I was confused.
Yeah.
It's fine. Thank you. You did a good job.
Yeah. Thank you so much.
I would say, no, there's not anything else. So yeah, I mean, if you guys don't have questions, I guess if you're done, you're done. But you gotta tell them bye before you just.
All right. Thanks for joining, guys. I'll have a host next time and a slideshow for you. So thank you.
Thank you.